Good evening, everybody. First of all, a reminder to all of us, please remember to switch on your phones at the end of the presentation. Isn't that a polite way of telling you what to do? I'm doing it myself. Okay, so everyone will remember to switch on their phones when the presentation's over, and we begin right now. If you could, sorry, Stefan, could you close the door, please? It's a bit noisy. Thank you. Thanks a lot. All right, welcome. My name is Selwyn Gerber, the founder of RVW, and I'm very honored to have many of the RVW team members here. Those who are not here are in the Memphis office, which is growing, and they're all with us in team and in spirit. We're here tonight really because it's the kickoff event for the year. We're very honored to have, one second, where is, okay, I'll introduce you in a moment. A fantastic speaker, there he is, perfect. I'll introduce him in a minute. And to welcome you all here. This is the A-list of clients. Every one of you is a special, unique, and valued part of our lives. And the way we work at RVW is you're not just clients, you're actually part of our lives, and we're very grateful to each and every one of you. You should know that we worry about each one of you all the time. That's what we do. We actually full-time warriors. And we make sure that everything we do is done to take care of you because, as you see over there, peace of mind is everything. I was once interviewed by the LA Business Journal, and the lady asked me, what do you think keeps your clients up at night? And I said, if anything we do keeps our clients up at night, we failed in our primary job. I want to tell you my own story because, in a sense, briefly, it really reflects on RVW. When I was 14 years old in Cape Town, South Africa, I was already fascinated by economics, business, and the stock market. And I went to my economics teacher and persuaded him that he and I should invest 100 shares together of a company that I had researched, which is still around, by the way, after all this time, called Irvin & Johnson, I&J. If you ever go to South Africa and you go to Cape Town, you'll see their logos all over the place. At that time, they did deep-sea fishing, processing, flash freezing, and shipping. Today, that is vastly expanded. They not only do that, but they also do vegetables and fish of all kinds and import and distribute. It's a huge, successful, still listed public company after all these years. When I got to university, I started selling mutual funds. There were two mutual funds in South Africa in the 70s. One was called SAGE, South African Growth Equities, and the other one was called NGF, National Growth Fund. And I sold mutual funds when I was a student. So you're not going to find anybody else who's my age, 72, who's been in this business since they were 14. Seriously, that's a lot of years. I've seen a lot of stuff. No, I've seen a lot of stuff. I've seen bull markets and bear markets. I've seen fads and trends. And as I tell the people in our team always, you know, flavor of the month is for ice cream, not for portfolios. And our whole approach is exactly the opposite of flavor of the month. Your normal Wall Street experience is they're always calling you up with something new and exciting. I'm happy to tell you we have nothing new and exciting to offer. The old stuff works just fine, and if you look at the people who understand how markets work, you can learn from them, and we do. We sit on the shoulders of giants. That's our claim to fame. I also want to tell you that those people who are part of the RVW team, could you just kind of wave, stand up, whatever? This is what I call the RVW jewelry collection. Each one of these is a precious jewel, really. An amazing group of dedicated people who would work. I mean, I'm not just saying that. I tell them at every opportunity how honored I am to work with people who care as much as we do, and they do. Everyone cares a great deal, and I hope that it comes through in every experience you have with our firm. I wanted to very briefly just cover some tax and estate planning issues, which are timely and important, and I think are actionable for each one of you. I'm not here to give you tax or estate planning advice, but I do want to run through some things that we think you should be thinking about now together with your estate planner. And if you want any of us involved in those conversations, we're happy to do so. First of all, in terms of estate tax, which is the grand exit tax, if any of you are in that category, you should know that the exemption, the exclusion, is scheduled to go down. It will go down, it will sunset from $13 million per person, which is $26 million for a couple, down to about 5 or so per person. So if you're in the position where you are anywhere close to those limits, you should really think about gifting now, because the IRS has already said that those gifts will be grandfathered in and they will not reduce they will not penalize you in any way if you've taken advantage of them. And by the way, for those of you who have a good longevity, if you give away, let's say $5 million, By the time you die, that $5 million, if it's invested correctly, could be 10 or 15 or $20 million out of your estate. So we're very big on gifting, and gifting can be direct, outright, or through some trusts with some controls and other aspects can be built into the trust. So I would say to you, those of you who have significant estates, you should seriously be looking. No problem. We can wait. Okay. So thank you. So no, it's just I get distracted. Seriously, it's not. It's a problem I have. I do get distracted by these things. So those of you who in that category, you should be speaking to your estate planners. You should be looking at taking advantage of this huge window of being able to deduct literally, an enormous amount of money. So that is critical. I mean, a married couple can take $26 million of assets, and a single person can take 13. That is enormous. And by the way, given the tricks and planning concepts that are available, you can squeeze a lot more money into that than is normally considered because of what's called discounts, discounting and fractional gifting and so on. I'm not going to give you a whole lecture on estate planning, but just know that if you're in a significant asset position, taking advantage of the remaining time before this huge exclusion sunsets by its terms, doesn't take any action on behalf of anybody, it will sunset in 2025. The second thing I thought we should mention, and we talk about over here very much, is out-of-state trusts. California, for those of you who haven't yet realized, that is by far the highest taxed state in the union. And when you live in this country, you could easily be at a 52% marginal tax rate. The good news is that the state of California has not clamped down on out-of-state trusts. And for those clients who have portfolios and or out-of-state real estate, the option of creating a trust in a tax-free zone like Nevada or Delaware, and Alaska, there are a whole bunch of them, should look at that seriously. You might find that you can save a lot of money, and it's certainly worth considering. I wanted to just talk briefly about the most recent changes. Secure Act changed the way you can leave beneficiaries to your retirement funds, and the Secure 2.2, 2.0, which we actually prepared a handout, and it is at the front, deals with when you take your required minimum distributions, which have now been extended in terms of time. You no longer have to take it at age 72, and also what they call catch-up contributions. Highly technical. I'm not here to give you technical solutions to your pension plan problems, but simply to say to you there are changes, they've been made. The Secure Act 2.0 was passed just a month ago. It's hot off the press, and for many people in this room, it's relevant to estate and tax and pension planning. So I wanted to mention those to you. With that, just a very brief synopsis of where we are and how we view things. I think you know that RVW is an evidence-based investment strategy. We sit on the shoulders of giants. We didn't have to figure it out. All we had to do is figure out where the high voltage outlets are, and they are there. So if you give up on the Wall Street machine, which I was victim to until, believe it or not, 25 years ago, when I read an amazing article called, "Is it possible to build a Rip Van Winkle portfolio?" And every now and again, I'm sure you can all think back to an article that kind of changed your life. Reading that article changed my life. I read the article and I thought, wow, for years we've been referring to the Wall Street types who we now hold in the highest disregard. People who have self-interest. But after 2008, of course, I don't have to do any convincing anymore because everybody knows who and what they are. But believe me, between the time we started and 2008, we were evangelists for a new way to look at things. Now, of course, everybody knows. There's not a big secret as to who they are. The whole idea of being in a business where you take secret commissions or commissions that are disclosed in such fine print that I'm actually made up a biblical quote to describe what Wall Street does. It says, "What the big print giveth, the small print taketh away." And that does not exist in any Bible, but I made it up because it explains a lot. And then you get into a position, and I recall in South Africa when I was growing up, it was illegal for a physician to own any share of a pharmacy. I'm sure you understand that. Well, in the investment world, it's not illegal for them to do the same thing. They can pump their own products, they can sell you their own investments, they can take incentives and prizes and rewards and awards, And of course, all of those things are disclosed, but you do need very good sight and a magnifying glass to find all the disclosures. And even if they are disclosed, they basically prevent you from being objective. When you deal with people who are what's called true fiduciaries, which is what we are, we have only one interest in mind, and that's the well-being of each and every one of you. Nobody pays us. We don't get awards. We don't get trips. We don't get incentives of any kind. Once you remove the conflicts that an absence of integrity present, everything changes. And then you're able to do what counts. And then, if you get rid of what I would call the salespeople, and you stick with the data-oriented people, then everything changes also. We don't have a sales team. We have an educational team, literally. If you scrape under the surface of RVW, you find a bunch of CPAs and CFAs. People are obsessed with data, not with predictions, forecasts, and all the stuff that Wall Street puts out. We're totally data-driven. And the body of work that we subscribe to is called evidence-based investing. That means we do what we know works over time. Not all the time, but over time. And that is the most exciting thing, just to understand that, how the process works. Those of us who've been with us the longest understand that the best. And by the way, you should know nothing we do at RVW is original. I want you to know that it's a mea culpa. We are not here to develop unique algorithms, theories, or approaches to investing. Everything we do is sitting on the shoulders of giants. And we can give you their names. I'm not going to bother right now, but we can give you the names of the people on whose shoulders we sit. And that makes us into the tallest guys in the room, not because of our inherent height. So with that, I'm going to hand over to Colin Patel. Colin is a very seasoned and senior person at the Spider Group at State Street. They basically kind of invented the ETF, believe it or not. The company that he's with invented the ETF, which from our standpoint is God's gift to the investment community. Low cost, no tax most of the time, and if there is any, there's almost none, and complete efficiency of transactions. That whole body of investment choices, the ETF world, was really brought to us by the Standard & Poor's people. The first one was called Spider. And with that, it gives me much pleasure to invite Colin. He's one of the senior strategists at State Street. And Colin, it's an honor to have you. Colin came in specially to do this presentation to us. We're deeply grateful to you for this. And I'm sure you have a lot of interesting things in store. When the key presentation is over, then Stefan So, who is our Chief Investment Officer at RVW, will be in dialogue with him over here. And I think you'll get to experience an interesting question and answer session. We did give everybody the opportunity to send in questions. Those that were received were already processed and are going to be included in what Colin and Stefan deal with. So with that, Colin, it's over to you. Thank you so much for gracing us with your presence. We're honored to have you with us.
Thank you, Selwyn. All right, I want to make sure everyone can hear me in the back. Can I just get a thumbs up in the back? There you go. Thank you. So, Selwyn, you use the words senior and seasoned. I don't know if that's a fitting set of terms to use, but I look like I should be at a crypto conference, not talking about stocks and bonds. But really, I thought I'd do a quick introduction as to why I'm here, what I do, and the firm that I work for. So I work for State Street Global Advisors. And as Selwyn said quite well, we invented the first ETF. But our roots go back quite far. It actually goes back to 1792. George Washington was still in the White House, and then we started a bank. And here's a fun fact. When creating a charter at the time, you have to get the local mayor to sign off on the bank charter, and the individual that signed off on our charter was John Hancock. So we have deep roots in American history. We go back quite far, and we've been investing for a long time. So there's some absolute truths that we've learned about the investment world. As Selwyn mentioned quite well, it's not about the flavor of the month, it's about long-term investing. And so that is really our approach to things here. And I work with RVW quite a bit because they are a data-driven firm. And so they're not looking to us to predict where the S&P is going to go. They want to see insight. What's actually happening in the market? What are the prominent risks that we can get ahead of? What can we do in portfolios to get ahead of those risks? And moreover, it's also important to know, what can we really say to ourselves to put us at bay? Key investing, the right way to invest is to really avoid all emotion, as we all know. And so that is a kind of partnership that we have with RVW. I'm going to speak quite a bit today about Fed action, perhaps even the debt ceiling, which I hope we go through today as well, China, U.S. equities, U.S. bonds, international as well. I think it's also exciting what's happening overseas. So Stefan has a list of prepared questions. So Stefan, I hope you can, feel free to come up and I'll take a seat with you. We can go through some of these questions. And as we go through this, I want to make sure that everyone knows that I'm going to share a lot of data and insight about the markets. You can double click on anything that I say figuratively. So what I mean by that is you can come up to me afterwards, get my business card. I'll send you an email. If you want to know, if I say something specific about the Fed, and you want to know exactly what I'm referring to and what's under the hood, I'd be happy to send you additional insight. So again, I'm here as a resource. I have a very good partnership with Stefan because, again, we have these meetings on a monthly basis, and I can't say that I look forward to them because Stefan grills me so much. Every single chart, every single data point I share with him, he's always asking why, how did you get that? And trying to dig one level deeper. And so I appreciate that about him, and I have a lot of respect for him. So I look forward to the discussion that we're about to have. And again, any questions I'm happy to take afterwards, but there's about 6 or 7 questions that we hope to go through with you all today.
Great. Can everyone hear me? Perfect. Well, first of all, again, thank you for being here, and thank you, everyone, for also being here as well. This is what we do during our investment committee sections, asking all the tough questions. And I'm glad you're all here to enjoy a nice dinner, but also this is kind of a sneak peek into what we do during our investment committee, again, sessions. So, last year was a fascinating year from a markets perspective, as everyone's familiar. Equities had a downturn. Even bonds, what were considered to be safe, down about 15 to 20%. So, looking at all of those factors, one area that we also really discussed was the fact that the best performing sector happened to be energy last year, up about 65%. And if you're looking at the worst performing sector, communications, Facebook happens to be part of that sector, was down close to 40%. So big divergence in performance. And one of the core investment philosophies that we always adhere to is diversification, as we've seen last year. So what are some of the things that you saw last year? What happened? And what are we looking forward to this year?
Yes, Stefan, we call it a twin bear market, right? The stocks were down. U.S. equities were down about 19%. Bonds down 13%. The average 60-40, you think about a target date fund, was down about 15%. For a lot of individuals in retirement, that's huge. That is not to be expected. It's a once-in-a-lifetime kind of event. In fact, the probability of that happening is about 2%. We've checked. And so it's something that is peculiar and has us all scratching our heads a little bit. But I do want to recall that back in 2008, the 60-40 went down about 22.5%. So this sort of thing we've seen in the past, Stefan, and I don't think it's that unique. In fact, I think there's some positivity coming out of this. What I mean by that is we've actually looked at data where the 60-40 has been negative, and we look at the following year. The subsequent year, the 60-40 is typically up. If you pick out the 10 worst years for the 60-40, in the following year, on average, the market is up about 13%. So was it a twin bear market? Yes. What does it mean for us? I'm happy to go into that, what it means specifically for bonds. But overall, I don't think it's expected to happen again as it pertains to bonds. Bonds actually look more attractive in this market environment. And you talked about energy. Energy's up 60%, right? Tech was down 30%. Bitcoin and crypto, right? All of my friends who were telling me that, oh, hey, you're boring, you're a value investor, right? I'm the one laughing now because crypto lost about 67%, about 2/3 of its market capitalization. So when we talk about losing 20% or 13%, I do want to put it in perspective because Meta was down. So Facebook, right, was down 65%-ish, give or take. So some of these high-risk stocks went down quite a bit. And the question is why? I think we all know that they were built on optimism, but what's actually happening under the hood? And so we think quite a bit about that. What is actually driving the underperformance? And what it is something we call valuations. So if you're an analyst like me, what you do is a lot of Wall Street firms, we don't do a lot of this, but you look at a company, and similar to Warren Buffett, you try to calculate the intrinsic value. And what you do is you create this mathematical model, and you divide by something called the discount rate, or the risk-free rate. And that is actually tied to interest rates. So what happens? When interest rates go up, you're dividing by a bigger number. Thus, the overall fraction, thank you so much, the overall fraction, the intrinsic value overall for a tech stock is now lower. And so Wall Street and a lot of these big firms had to look at these stocks and they said, wait, hold on. We valued Apple at $200 a share, et cetera. I'm making that number up. And now we see when we do the math, it should be at 150. And so there's this change in perception that happens. We saw a lot of that last year. We expect to see more of it this year. And I'm happy to talk more about our outlook because I think it's interesting. But I think what has led the market over the last 5 to 10 years, large cap, tech, I think we're up for a different regime. I think the next 5 to 10 years, Stefan, is going to be much like call it the 5 to 10 year period we had after the dot-com bubble burst, where small caps came back, value came back, and international came back as well. So I'm happy to talk more about the fundamental drivers of each of those, but I hope that puts it into perspective. Gold was flat last year, which was also surprising to us, but when you actually look at what drives gold, it works in the opposite direction as the dollar. So we had a strong dollar. Gold works in the opposite direction. So we expect gold to come back and some other asset classes, but overall, it was a tough year in perspective.
Yeah, great points, Carlin. And so another question is, how are investors feeling today? Because, we're looking back 2020, 2021, when the interest rates were low, or basically money was free.
Yeah.
A lot of the names that did well, maybe Teladoc, you guys may have heard of it. That's one area, visiting online, doctors via online. Another area is maybe Zillow. Zillow did really well during 2000, 2001, but these names were down 85%, 90% off its highs. So, how are investors feeling today, and perhaps, what are individual investors doing maybe differently than, say, an institutional endowment type of clients?
Sure. We split that up into two parts. So there's retail investors. So I think about my parents, friends and family, or we can all think about friends and family in that scenario. How are they investing? Right? When you go to the coffee shop and the individual behind you is talking about the stock market, what are they doing? That's what we call retail investing. And no surprise, retail investors get it wrong most of the time. And so what we do is we look at the AAII index. That's the American Association of Individual Investors. It's been around since the 80s. And basically, it's a good gauge of what the average Joe is doing in portfolios. So they have a few 100,000 people subscribed. And what they do is every week, they send out a survey to a subset of their subscription. And they say, do you think the markets over the next 6 months are going to be up, down, or flat? And moreover, how much do you have in stocks? What about bonds? What about cash? And what we do is we track that survey week after week, month after month. And Stefan, what we're seeing right now, which I find interesting, is that the average retail investor is still worried, but they're actually becoming more optimistic, which I find surprising because Wall Street is doing the opposite. So I talk about tracking the retail money, but we often talk about smart money in our industry. That's what Goldman Sachs is doing, what JP Morgan is doing. That is actually typically smart money gets it correct. So I also want to know, what are the big players doing in the market? And what we find is that in general, right now, they're starting to get more defensive. They've only just started to get defensive. So we track something called the State Street Confidence Index. So again, we have about $4 trillion in AUM. We're one of the biggest asset managers in the world. But what we do is, because of the bank side of the business, we have our hands on about 10% of all the money in the world, more than $40 trillion. And we characterize that money, this smart money we call it. So we look at what the pensions are doing. What are the big endowments doing, right? The Harvard endowment model as an example. And what we're finding is that they have been optimistic for quite some time, surprisingly. Even 6 months ago, when retail investors were getting defensive, they were still optimistic in general. And then about 6 months ago, they became neutral. So between stocks and bonds, if you think about a typical 60-40, they were maybe right there at 60-40. And now, only just now, are they getting more defensive, shifting more to bonds, shifting more to cash. And so they're a little bit late to the game. And what it means for us is that the market may go down a little bit more because smart money has a correlation to what actually happens in the market. Because what you and I do in the market, what we do in our accounts, retirement accounts, doesn't move the dial a whole lot. But when JP Morgan makes a change, when Goldman Sachs makes a change, that means something. And so that's more meaningful to us. And right now, again, they're shifting that dial. They're becoming more defensive. So it's something we're watching closely.
Right, and when we're saying defensive, it could also mean, when we're trying to buy a car, we might look at different factors or attributes. It could be EV cars now, gas-powered cars. Do we want leather? All of those things. So, what are some of the ways to get defensive when you're looking at the stock market? Is it profitability? What are some of the factors you like in this type of environment?
Absolutely, that's a great question. Does everyone know what a factor is? Stefan uses the word factor. I'm going to use it as well, but I want to make sure we're all comfortable with that term. So I'm getting a few mixed answers. So let's maybe go over what that is. Factors in the investment world are characteristics. So I think you used the car example, but in the same way, I think of someone applying to college. That candidate, if they're trying to get into Harvard, Harvard's going to look at what is his or her GPA, where did he or she go to school, what about SAT score? Those are all characteristics, and you can maybe put a number to each of those things. And so Harvard would then choose to accept or deny this applicant based on those few characteristics. And that's exactly what we do with stocks. Is we know long-term, this actually came back from the 90s, and I know you know the research quite well, Stefan, but a few individuals, Fama and French, wrote a very famous paper in the 90s, early 90s, about what are the characteristics that lead to stock performance over time. What they found was it was three things. It was the stock's exposure to the broad market, how much value the stock had, so how cheap is it, basically. But then also, is it small? Because smaller companies tend to outperform long-term. And when I say long-term, I mean 10 years plus. So today, there's more factors. I listed 3, but in the past 30 years, there's been a lot more research put out suggesting that there's maybe 5 or 6 big factors. And what we find is that today, you asked about what are the factors that we think are going to outperform. Dividends, I think, are key. So dividends have 3 characteristics that I like right now. One is the yield stability. So in this situation, I'm going to be honest with you all, I don't know where the S&P is going to be in 6 months. No one does. Wall Street doesn't. This time last year, JP Morgan, Goldman Sachs, and Citigroup all said that the S&P was going to end the year at around 5,000. The S&P, I can see the look on some of your faces, the S&P ended the year at 3840 and some change. And so Wall Street got it wrong with all the manpower that they have and all the resources. And so predicting the stock market, we believe, doesn't make a whole lot of sense. What we do know to be true is that these factors, these well-researched fundamental characteristics about stocks, do lead to outperformance long term. And that's what we choose to invest in. So I like dividend payers right now because if you look at the type of companies, they're stable companies that have been around a long time, sometimes more than 50 to 100 years. And they've seen market cycles time and time again, and they've gone through it successfully. And so in a situation where I don't know what the price is going to be, I don't have a lot of purview into that, I like what is predictable, and that's my dividend yield. I want to make sure that I get paid to wait in this unpredictable market, and dividends are one good way of doing that. Now, secondly, I listed 3 characteristics. Secondly, I like the fact that dividend payers do a pretty good job fighting inflation. So they have what I call inflation immunity. So if you look back about, let's say 75 years, in situations where inflation was above 5% or between 5 and 3.25%, what we find is that dividend payers outperform the broad market by about 4 to 5%. Moreover, that's looking back 75 years, but if I look back about 60 years, I find that in every recession, the average stock is down about 17%. That's how much the market's down. However, dividend payers are down about 9%. So they typically outperform. They're defensive, Stefan, but then they also provide some of the upside potential that we all want when we pick stocks. So I really like dividend payers at this point in the cycle. I think value is great too, but here's the thing about value and growth. I don't know if you've all seen this. Right now, ExxonMobil and Chevron are growth companies. technically speaking. And guess what? Meta, Amazon, Microsoft, and Netflix are value companies because of the performance that they had last year. And so some of you are scratching your head, and I feel the same way. I feel absolutely the same way. Picking value over growth sometimes works, but the definition is quite ambiguous. And so what we want to do is we want to pick these factors, because if I pick a dividend-paying mutual fund or ETF, the composition doesn't necessarily change year over year. So it's a little bit more stable over time.
And now going to some of the tougher questions we've received. I don't know if everyone's been shopping lately, but eggs are out of control these days. And so perhaps that's due to inflation, maybe there's a supply shortage. But what do you make of inflation in general last year, and is it finally getting under control? We saw that some of the figures around inflation, whether it's CPI and so forth, are starting to trend down. So what are some of the data points you're seeing?
Absolutely. I know inflation is a hot topic. I spent a lot of my time talking about inflation. CPI, you have PCE, personal consumption expenditures. It really is a mess. There's about 4 or 5 different inflation metrics. But long story short, they're all high. But good news is that they're coming down. So we hit a peak, of course, north of 9% for CPI. Now we're seeing it come down, 6%, 7%. We're seeing more realistic numbers. It seems to be coming down as quickly as it went up, which is a great sign. I think the Fed's going to try to take full credit for that. So that's a story for another day, right? But really, as I think about inflation, we knew it was going to come down this quickly. Wall Street knew. The reason why is because there's leading indicators for CPI. So CPI, 30 to 40% of it is housing. So I can look at how the government defines CPI and try to make a projection of where it's going to be, or I can look at real data. So I look at the ZORI, the Zillow Observed Rent Index. I like looking at Zillow data. Or for cars, the Manheim Auction Index. So I'm watching used car prices, real time, and what Wall Street figured out very quickly, months ago, was that the real-time data showed that prices were definitely coming down, but inflation was still working in the opposite direction. We're now at a point where we're seeing inflation come down as expected. Our target for CPI is 4% by the end of the year. Most firms think it's going to come down to 4%. I actually see a lot of Wall Street firms saying it's going to be 4% by the summer. So I would even go so far as to say that we are a little bit more conservative when it comes to that estimate. But CPI is coming down. Good news for us, because it means that the Fed thinks that they've done their job, and hopefully they'll stop hiking and they'll start cutting rates at the end of the year, which I'm happy to talk about. But really all eyes are on the Fed right now. Interest rates are everything, and Warren Buffett says this as well. Any asset class you can think of in the capital markets, whether it's stocks, bonds, gold, they're all related to interest rates. And this cycle that we've seen, the Fed going from virtually 0 to 4.5%, is the quickest I've seen it. I know that's probably not saying much, but it's the quickest we've all seen it, I think, in a very long time. So we're watching the Fed closely as it pertains to CPI, but that is one big question that we have in the back of our mind.
Right. And besides the price of eggs being the toughest question, the second one was around interest rates and the Fed, and you made some great points around that. So going forward, given that we've seen such a big increase in the Federal Reserve raising interest rates, one of the ways we positioned the portfolio working with you was orient more towards value rather than growth, which helped out tremendously. Last year, value was only down about 5-6%. If you're looking at the growth side, down closer to 30%. So, what do you think the Fed is going to do now that the CPI figures are starting to come down, and what are you thinking from a portfolio perspective?
Yes, 2 very good questions. I think the Fed, well, let me talk about what the market thinks, and then I'll tell you what we think here at State Street. The market says that the Fed's going to hike a few more times, meaning that they'll get from 4.5% to probably about 5% over the summer. And I heard no way. You think higher? You think the Fed is going to get higher? Okay. So I hear mixed responses all the time. I hear that the Fed is going to stop at, let's say, 4.5 or 4.75, or maybe go up to 6%. So we think that the Fed may go to about 5%. That makes a lot of sense. But what the market doesn't realize is that there's a 12 to 18-month lag effect when the Fed plays with the rates. So one of our key resources is Richard Fisher, who was the president of the Dallas Fed from 2005 to 2015. His mentor was Paul Volcker, who, as some of you know, led the Fed from 1979 to 87, dealing with high inflation. And what Volcker used to say to Richard Fisher was that when the Fed plays with rates, it's like not like playing with a light switch where you turn it off and right away you see the impact. It's like playing with a dimmer, but moreover, playing with a dimmer such that you make an adjustment and you have to wait 12 to 18 months to see the effect. Imagine that. Imagine sitting in a room, adjusting the switch, and waiting a year and a half to see what happens. That's what the interest rate game is. We know that, Wall Street knows that, and the Fed knows that. And so the reason I bring this up, Stefan, is because I think what the Fed is going to do is they have to wait more than they have. They've hiked so aggressively, and they need to hit that terminal rate of, let's say, 5 or 5.25, whatever it ends up being, and they have to push pause and see the full economic repercussions of what they've done. They have to look at the labor market data. They have to see what's happening in the stock market. They have to look at corporate profit margins. And I think there's a lot of waiting to be done. But as you talk about what to do in portfolios, here's the thing about interest rates. We've done a lot of analysis at State Street. And what we do is we've mapped interest rates with the stock market over the past, I want to say until 1963. And what we find is that the market bottoms after the Fed starts cutting. So I don't think we're going to hit a recession, the deepest part of the recession, in the next few months. I think that deepest part of the trough is yet to come. I think it'll come probably later in the year or perhaps the year after. Now, our base case is it's not going to be that deep from where we are today. But what to do in portfolios, I think it's about really managing risk overall. So total portfolio, from a total portfolio perspective, the majority of your risk is coming from stocks, as we all know. We call that equity risk. So we've gone through a good portion of the downturn. Bonds have gone down because of what the Fed has done. I like cash. I like shorter-term bonds right now because they're less sensitive to interest rates. It still makes sense to us, especially as we expect more, let's say, sour economic data to come in. But it's going to be a troubling environment over the next 6 to 12 months. Think of high volatility, but here's the thing about the market. It looks forward. There's a difference between economic data and the stock market. So I'll take us back to 2020. If you draw a line from March 2020 to, let's say, the end of the year, you'll see that the market rallied. This is after COVID was announced. The market rallied 65%. We were in the height of the pandemic. We were still in lockdown, and the market rallied. Why is that? It's because the market is a forward-looking mechanism. I like to think of it as we're in a cave, and when we feel the walls caving in and we see no light, we get worried, we get overly pessimistic, we make changes to our portfolio. But once that light creeps in from somewhere, we get optimistic. And that is when the rally begins. So even though I talk about this deeper trough, it doesn't make sense to sell right now or go 80% in cash. Because we don't know when that rally is going to begin. It very well may begin in the next 6 months or 9 months. I don't know. But I can tell you that it will happen when we least expect it.
Right, and that's why we stay invested on that point. 2020 was the fastest bear market ever, followed by the shortest bear market ever, given that it recovered so quickly. And you made another good point about keeping bonds short. That's what we do as part of our investment philosophy. Shorter-term bonds, the goal there is to collect the income, and it's there for lifestyle needs and so forth. And so, I think given that it's getting towards the later in the evening, I think the final great question was looking at all of these type of factors. And one area that we really saw was gearing towards perhaps institutional funds last year. All of the institutional funds that our clients are holding performed positively last year. And given our discussions around also value, we protected the downside. One last factor I think that was a part of a good discussion was quality. And quality, we think, would do better in this time. We're tilting towards it. What do you like about quality? Could you just explain that factor a little bit more and what that exposure is like?
So quality, I realize that we're running out of time, so it really did fly by. Quality companies are ones that have stable balance sheets, stable earnings, low debt. Let's talk about debt for a second. Carvana, right? I see some of you, I live in Arizona, right? So I see those big vending machines.
One of those companies that fell 95% from its peak.
95% exactly.
Are you talking about death or debt? I wasn't sure what I heard.
Debt. They have over $7 billion in debt on their books. A lot of it, we know they can't cover. And moreover, if you look at the life cycle of a car that they take in, so you look at their inventory, it used to be about 6 weeks. Now it's about 3 months. So you can imagine when you have a good amount of debt, your revenue is struggling, it's taking longer to turn over cars, a company like that is definitely not a quality company. And so we look for stability, stable earnings, low debt relative to the assets that the company has. And those are some of the key factors. But I think quality is going to be good. And dividend payers are one of the best way to secretly embed that quality in. So you get with the dividend payers, you get quality, you get value, and you're getting paid to wait. And so from my perspective, it really is a trifecta of benefits that you're getting at one point in time.
As all the core members of the investment committee or CPAs, we love hearing these type of metrics. And thank you again for your time. Thank you, everyone, for coming.
Thank
we'll
you.
let someone wrap up.
Thank you very much.
you.
First of all, thank you very much. Just a brief summary of how we view things. First of all, we don't think the smart money is so smart, by the way. And if you pay attention to what Colin said, you'll realize they were late to the party. We don't think the Fed is so smart either. They got it dead wrong multiple times. And if you looked at your reports from RVW, and if you didn't get one, you can send an email to any one of us. But Ben Bernanke, about 10 years ago, apologized on behalf of the Fed for getting it dead wrong at the time of the Great Depression, by the way. So the error started there. In this cycle right now, the Fed slept through the increase of inflation from 2% to 8% before they woke up, while they continue to use the word transitory to describe inflation, which misled a lot of investors and was wrong information. They didn't look. So if you want to know what we think, we don't really place the smart money in the smart column. They're not so smart, as you heard from Colin. They woke up pretty late. We don't think the Fed is so smart either. They've got it dead wrong on multiple occasions. We prefer the Buffett approach. Buy great businesses that make business sense. I often think of my late grandfather, and we view equities as if you were buying a piece of a business. And I was very close with my late grandfather. Those of you who know me from the old country know we had one of the great love affairs of all time. He was a businessman, he had a factory, and we actually shared a room for quite a few years. We were very close, and he still talks to me. He's still there. I don't have a mental problem, but his influence is very strong. And I often think, what would he say if I showed him what we were investing in? And I want you to know, the stuff we buy for ourselves and our clients is exactly the kind of thing that an old trader would love. Profitable, real profits, cash in the bank, strong balance sheets, not over-leveraged, paying dividends to people, to the owners. All the factors that make compelling sense. It's not science, the stuff we do. The question is to resist the impulse to follow the masses. They say the masses, them asses. We have to have the guts to resist following the masses. And it's not easy, because when everyone else thought Tesla was amazing, we didn't. I want you to know, none of you owns Tesla in your portfolio, not one. When everyone thought crypto was amazing at $70 a coin, we didn't. We couldn't understand what they were buying. And by the way, those people who bought cryptos don't know what they own to this day. Ask them to explain to you what they own. Well, we don't buy anything we don't understand. So the bottom line is, what really turns out to be the best approach is common sense, business sense. That's what it means. It means all the stuff that old-fashioned traders would have liked. Think about Buffett. And by the way, we spent a lot of time in Omaha, a lot of time. I personally have read almost everything he's ever written or said, and the same with Charlie Munger. We know these people and their thinking very well. It influences very heavily what we think of. And I can assure you, he wasn't interested in Tesla, and he didn't buy crypto. You should hear what him and Munger thought of crypto. They call it rat droppings, by the way, almost exact. Yeah, that was their exact word, by the way, from Munger, one of the smartest people on the planet, by the way. So old-fashioned works. Stay to the basic principles. Don't get tripped up and trapped into the trends and fads. It works really well. The one thing I wanted to say, because I think it's really important, is over the last year or two, we have introduced some alternative investments. And those have really come into their own because the categories become more sophisticated and accessible. And those of you who are in the real estate funds that we put clients into, the private credit that we put clients into, have already experienced that because every alternative fund that we used in 2022 made money, every single one. We have no losses in 2022 from our alternatives. And it's an area we want to push more and more because it does give all of us the opportunity to own fractional interest in high-grade investment quality real estate that's income producing, and also to be in the lending business with huge financial institutions where we become part of the pool that they lend to very secure investors. I would highly recommend that if you don't have these in your portfolio and you're interested, that forms part of the bucket, which is a cash generating bucket. And as we move forward, you should know our approach is very much to create buckets. Safety bucket, an equity bucket which provides growing income over time and growing value, and alternates, which are cash flow generators. And that's primarily income producing real estate and credit, which means lending money to very profitable, very secure companies, and the loans themselves are secured. So with that, I will draw it to a close. Those of you who want to ask any questions, please do so. Stefan will be around. All of us will be around. Thank you very much. If you have any questions after this, set up a meeting with any of us. We'd be happy to meet with you to discuss any aspect of this, your portfolio, alternatives, and we'd be happy to meet with you and your advisors on tax and estate planning issues, which are very timely for right now. Thank you very much. Good evening.